Supplier and buyer power. Csca. Explain how end users, wholesalers, and retailers affect the price and the cost of products throughout the supply chain. End users influence pricing power through demand elasticity, brand preferences, and switching behavior. If customers are price-sensitive and perceive products as undifferentiated, firms face pressure to lower prices, reducing margins throughout the supply chain. Conversely, strong brand loyalty or product differentiation allows firms to maintain premium pricing. Customer expectations regarding quality, service, and customization also increase operational costs, affecting production, logistics, and after-sales support. Thus, end-user behavior directly shapes pricing strategies, cost structures, and overall profitability. Wholesalers act as intermediaries that aggregate demand and distribute products to retailers or other businesses. Their bargaining power can affect manufacturer pricing and margin allocation. Large wholesalers may demand volume discounts, promotional support, or favorable payment terms, shifting profit margins upstream. However, wholesalers can also reduce distribution costs through economies of scale and logistical efficiency. The strategic relationship between manufacturers and wholesalers therefore influences cost control, inventory management, and pricing consistency across markets. Retailers significantly impact final pricing and brand positioning, especially when they possess strong market power or direct customer access. Large retail chains can negotiate lower wholesale prices and impose slotting fees or promotional requirements, affecting supplier profitability. Retailers also influence pricing transparency and competitive comparisons at the point of sale. In some cases, private label products increase competitive pressure on branded suppliers. Therefore, retailer power can compress margins, shape promotional strategies, and alter supply chain cost dynamics. Csca. Evaluate the strength of buyers for a given industry and organization. Buyer strength is determined by factors such as concentration, purchase volume, and availability of alternatives. When buyers are large and purchase in significant quantities, they gain leverage to negotiate lower prices or better terms. If many alternative suppliers exist offering similar products, buyers can switch easily, increasing their bargaining power. High buyer concentration relative to the number of suppliers strengthens buyer influence and can significantly reduce industry profitability. Buyer power also depends on switching costs, product differentiation, and price sensitivity. If switching costs are low and products are standardized, buyers can demand price reductions without significant risk. In contrast, strong differentiation, proprietary features, or long-term contracts reduce buyer leverage. Price-sensitive customers in commodity industries tend to exert stronger bargaining power, while buyers in differentiated markets may prioritize value over cost alone. Evaluating buyer strength requires analyzing the buyer's ability to integrate backward, access market information, and influence industry competition. If buyers can produce the product themselves or sponsor new entrants, their power increases. Transparent pricing and digital platforms further strengthen buyer influence. High buyer power typically compresses margins and intensifies competition, requiring firms to pursue differentiation, customer loyalty programs, or cost leadership strategies to mitigate bargaining pressure. Csca. Demonstrate understanding of how suppliers can raise the price of inputs. Suppliers can raise input prices when they possess strong bargaining power due to concentration or limited alternatives. If a few suppliers dominate the market or provide specialized inputs, purchasing firms have limited negotiating leverage. This is particularly true when inputs are critical to production and lack close substitutes. Under such conditions, suppliers can increase prices, reduce quality, or impose stricter contract terms without significant risk of losing business, thereby increasing costs throughout the value chain. Suppliers gain additional power when they offer differentiated or proprietary products, such as patented technology, unique raw materials, or highly specialized services. When switching to alternative suppliers is costly or operationally disruptive, buyers become dependent. High switching costs, due to customized systems, long-term contracts, or retraining requirements, enable suppliers to demand higher prices while maintaining stable demand relationships. Labor can also function as a powerful supplier, particularly when skilled workers are scarce or unionized. Tight labor markets increase wage pressures, raising operating costs. Similarly, suppliers may threaten forward integration, entering the buyer's industry directly, which strengthens their bargaining position. When these conditions exist, suppliers can significantly influence production costs, reduce margins, and shape overall industry profitability. Csca. Evaluate the strength of suppliers for a given industry and organization. Evaluating supplier strength requires analyzing supplier concentration relative to industry buyers. If a small number of suppliers serve many firms, supplier power is strong. Conversely, when suppliers are numerous and compete for business, buyer firms have greater leverage. The uniqueness of supplied inputs and the availability of substitutes further influence supplier strength. Limited alternatives increase dependency and pricing power. The importance of the buyer to the supplier also affects bargaining dynamics. If a purchasing firm represents a significant portion of the supplier's revenue, the supplier may have less leverage. However, if the supplier serves diversified customers or operates in high-demand markets, it may impose stricter pricing terms. Evaluating these interdependencies helps determine the relative power balance within the supply chain. Switching costs, threat of forward integration, and input differentiation must also be assessed. High switching costs increase supplier power, while credible forward integration threats further strengthen it. If supplier power is high, firms may pursue strategies such as vertical integration, long-term contracts, diversification of sourcing, or development of substitute inputs to mitigate cost risk and protect profitability. LOS-Y. Demonstrate understanding of Porter's 5 forces model and apply it to an organization and its industry. Porter's 5 forces model analyzes industry attractiveness through 5 competitive pressures: threat of new entrants, bargaining power of suppliers, bargaining power of buyers, threat of substitutes, and rivalry among existing competitors. Together, these forces determine long-term profitability potential. The framework emphasizes structural industry characteristics rather than short-term performance, guiding strategic decisions about market entry, positioning, and competitive defense. Applying the model requires systematic evaluation of each force within a specific scenario. For example, high entry barriers reduce new entrant threats, while intense rivalry and strong buyer power compress margins. Substitute availability limits pricing flexibility, and powerful suppliers increase input costs. By assessing each force's relative strength, managers gain a comprehensive understanding of industry dynamics and risk exposure. Strategic implications depend on the combined force intensity. When forces are strong, industry profitability declines, requiring differentiation, cost leadership, or niche-focused strategies. When forces are weaker, firms may achieve sustainable competitive advantage more easily. Effective application of the model helps organizations anticipate competitive pressures, allocate resources strategically, and enhance long-term positioning within their industry. Complementary products and services. LOS-Z. Demonstrate an understanding of the economic and strategic implications of complementary products and services. Complementary products and services are those that increase the value of another product when used together. Demand for one product positively affects demand for its complement, such as smartphones and mobile applications, or printers and ink cartridges. Economically, strong complements can increase overall market demand, enhance customer value, and support premium pricing. Firms may price one product competitively to stimulate demand for higher-margin complementary offerings. Understanding these demand interdependencies is critical for revenue optimization and long-term profitability. Strategically, complements can create ecosystems that strengthen competitive advantage and customer lock-in. By offering integrated products or forming partnerships, firms can increase switching costs and differentiate their offerings. For example, proprietary software platforms, subscription services, or compatible accessories reinforce brand loyalty and limit substitution. Companies may pursue alliances or vertical integration to control key complementary components, thereby capturing additional value within the supply chain and protecting their strategic position. Complementary relationships also influence industry structure and competitive dynamics. The presence of strong complements can reduce rivalry by expanding total demand, while the absence of compatible complements may constrain growth. Firms must monitor technological shifts that alter complementary relationships, as disruptions can weaken established ecosystems. Strategic planning should incorporate complement analysis to identify partnership opportunities, bundling strategies, cross-selling initiatives, and potential risks if complementary providers gain excessive bargaining power.